26th, Financial Sustainability Committee meeting. This morning, Chairman Petoskey is unavailable to be here, so we'll need a chairman, and if there's a nomination from the board, we'll look for that.
Move for Brian Keeps to be our chair for the meeting.
I second that.
Okay, we have a motion and support. All in favor?
Aye.
Okay, thank you. I am the chair. And with that, we'll note attendance. Both Chairman Petoskey and Supervisor Walsh are not present this morning. All else are present. Now we'll open up for public comment.
My name is Mark Intockley. I'm a Bloomfield Township Precinct 3 delegate. I would like to understand why our pension fund returns did not perform at the same level as the OPEB Bloomfield Township funds over a 2-year period from April 1st, 2020 through March 31st, 2022. When we look at the minimum actuarial report, what we see is they claim that there were a little over $1.6 million in the town fund. And what Milliman tells us is the funds were allocated to individual groups based on the respective accrued liability. Now, what happened over the next 2 years when you look at the GASB filings, the town portion of the fund after the split generated $2.5 million in investment income net expenses. And that's less contribution. That's an 80% return. And I would like to understand why with the same group, ANCO, the similar investment strategies, why the fund returns weren't the same. Unless, of course, the investments and investment income during that time period was not distributed based on the as Milliman states, based on the individual respective accrued liability of the public safety funds and of the township funds. That would definitely be inappropriate. But with the 80% return, we'd be fully funded on the pension. Over those last 2 years, we would also not need to make contributions. Secondly, the Financial Sustainability Board is also supposed to review the actuarials and give instruction and advice to the township regarding contributions. Those funds last year, from January 1 through December 31st, dropped over $20 million. I believe that'll be a significant impact to the forthcoming actuarials. And what's the assessment and recommendations with respect to budgeting contributions to that fund, and whether or not this group will actually review the GASB disclosures, which are part of the budget. And I want to thank particularly Sean from the clerk's office, who spent time with me yesterday and advised that forms for GASB are not on the township website, and he will send me the updated forms later this year when they become available. Thank you.
Thank you. Is there any other public comment? Hearing or seeing none, I will close public comment. Next item is approval of the meeting minutes of January 31st, 2023.
So moved. Support.
All in favor?
Aye.
Any opposed? Okay, that carries. Items for discussion. We have Brian Green from ANCO and Company. And Brian, if you would provide us a presentation on the first quarter financial results, we'd appreciate it.
Sure. So I'll dive into the book and talk about things from an overall market standpoint. So kind of the story of the first quarter is we think of first quarter in comparison to last year. Remember last year the conversation was around negative returns across the board, despite a significant rally in the fourth quarter, and that wasn't enough to offset what had happened, particularly in the second and third quarter of the year. March 31st also wraps up the fiscal year, so we'll spend a little bit of time talking about the quarter as well as that trailing one-year time period, since that's an important piece to the township. But kind of the summary as we think about the first quarter compared to last year is what was first is last and what was last is first. Literally, the leaders of last year are the laggards of this year, and the laggards of last year are the leaders of this year. If you asked me to say that again 3 times fast, I don't think that I could. So just talking in broad terms, the S&P was up 7.5% for the quarter. Absolutely fabulous start to the year. Mid-cap stocks are up 4%. Small-cap stocks are in positive territory. International markets were in positive territory. 2 big surprises. Number one would be the significant rally we saw in fixed income. Believe it or not, we saw rates on a longer-term basis decline pretty significantly. And you can see that bear out if you look at the U.S. aggregate bond return for the 3-month period. High-quality U.S. fixed income maturing in approximately the next 7 years was up, we'll call it 2.96, let's call it 3%. 2.5 of that 3% came in the month of March, which meant in January and February it was up collectively 0.5%, and then a 2.5% run in March brought us to that 3% figure. And about 2/3 of that came from yield, and about 1/3 of that came from a rally in prices as we saw interest rates fall. To give you an idea of that, the 10-year, for example, ended calendar year 22 at 3.87%. It ended March at 3.47. We actually saw it north of 4 at one point, and we saw it below that 3.47 figure at some point. So you may look and say, well, 0.5%, but remember on a percentage basis, that's a 15% move. That's a 15% decline in rates, which is why we saw that rally. Same story of first to last and last to first. Calendar year 22, S&P down 18%. Number one performing sector, energy, up a whopping 65.4%. The 3 worst performing sectors, information technology, consumer discretionary, communication services, all growth-oriented sectors. Rates rose last year, right? Now we look at first quarter of this year, we're talking about rates declining, not on the front end of the curve, right? Not Fed funds rate, not 3-month, 6-month, 9-month, 12-month, but 7-year, 10-year, 20-year, 30-year rates decline. Worst performing sector, actually financials, energy is the second worst performing sector, but the 3 best performing sectors so far this year are information technology, communication services, and consumer discretionary. The 3 worst performing from last year are the 3 best performing so far this year. Whether that trend continues, we'll see. I don't expect that it will. I see a lot of that rally we saw in the first quarter is, tech names rally on a decline in interest rates. So to the extent we see rates continue to grind higher, or at least normalize from this point, you may see that performance differential level off. I always think this chart is powerful from a longer-term standpoint. The idea being back in March of 14, the decision to invest this portfolio into equities rather than just holding it in cash, allowing it to be subject to Public Act 314 investment limitations versus Public Act 20. Think about it going back to April of 14 with an $84.2 million beginning market value. We've had net cash flow out, that's been contributions over to the Prudential contract, of just shy of $48.8 million. We've had market gains over that time period of $45.8 million to have us where we are today at $81.2 million. Cash has become attractive here as of late, but that number from 2014 to 2020, midway through 2022, is a lot closer to 0 than it is to 1 because of where we were from an interest rate environment standpoint. So the decision to have this money to take risk, right, intelligent risk, thoughtful risk in the portfolio, there is $46 million more today than there would be had this been kept in a more conservative portfolio. Yes, at times there's been more than that. We go back to the end of 21, and there's certainly been times where there's less than that when you go back and look at 2019, 2020. But all in all, over that now 9-year stretch, it's definitely been a success. So how did we fare? Looking a little bit more detailed. So the overall DB equity portfolio, Remember, this is predominantly U.S. and international stocks with a little bit of real estate exposure. For the quarter, was up 6.4%, ahead of the policy index that was up, I call it 5.6, and ranked in the 59th percentile. On a fiscal year-to-date basis, so wrapping things up for the fiscal year, down 5.6 versus the policy index for that same time period that was down 6.5, and essentially middle of the pack, actually 50th percentile. So what helped and what hurt? Ancora, remember, value dominated last year. It's hurt so far this year. Their underperformance is really driven by just a couple of healthcare names like J&J and United Healthcare, as well as Home Depot. Fidelity S&P 500, no surprise, up 7.5%, right in line with its underlying index. Of note, pretty narrow leadership. I think it's 7 or 8 of the names. There's 7 or 8 names responsible for 90% of that return. Apple, Microsoft, Meta, NVIDIA, Tesla all rallied significantly in the quarter. Edgewood, continuing that story of first to last and last to first. Tremendous rally in growth stocks, as well as a little bit of outperformance for Edgewood. Biggest driver of their outperformance was being overweight NVIDIA, and had the benefit of that stock being up 90% in the first quarter. It sits at about a 7% position, which is a middle-of-the-road position for them. Remember, that portfolio is always 22 names. Clarkston, same story. What was first is last, right? Leader to laggard, laggard to leader. And the last year has done a fabulous job. In a difficult market environment where their benchmark's down 10 and change, they were down just shy of 2%. First quarter, as markets rallied, they lagged. Some of the drivers of that lag have been drivers of their success, names like Stericycle and Affiliated Managers Group. And one continued laggard continues to be Altice. It's been a conversation on a regular basis, the cable company in the Northeast and in Texas, which I still absolutely love that story of if we can eliminate the cable aspect of it, the customer support line that we have to maintain goes away or is greatly diminished. And now it's just technical support on the internet service, and it's no longer calls of my remote doesn't work that are apparently expensive to field, just in terms of how they're going to change that business. The complement to that Clarkston portfolio, remember Clarkston's small mid-cap, there's 23 names in that portfolio. They will hold cash at times based on a stock hitting their price target and not finding attractive opportunities. That's obviously what's helped them in the last year, but the Fidelity Extended Market Index Fund, remember that is the entire U.S. equity market. Take out the 500 names that are in the S&P 500 and own everything else. So I'd mentioned at the earlier meeting, Tesla is a name that came up. Tesla was one of the largest holdings in that index fund for a very, very long time until they earned their way from a quality of earnings standpoint into the S&P 500. So the S&P 500 isn't just the 500 largest names in the U.S., Ford was out for a while, GM was out for a while, so you can come in and come out based on having negative earnings. But it was the largest names here that drove performance, Airbnb, Uber, Blackstone. Interesting, those were all drivers of underperformance last year for that index fund. Shifting over to things from an international standpoint, Oakmark up 14% versus benchmark up 8%. So outperformed by 6%. We're actually number 1 in their peer group. That has now lifted their returns where it now looks solid on a 1-year and on a 3-year basis. This was a surprise. Oakmark has a value bias to their portfolio. They own a lot of automakers and auto-related items, and those are not growth stocks by any stretch of the imagination from a traditional automotive standpoint. Tesla is a different conversation. But performance for them was led by Continental AG, BMW, Mercedes, 3 of their largest holdings, all did well in the first quarter. So this one was a bit of a surprise, just given the value bias. I would have expected, hey, benchmark's up 8, if they're up 5 or 6, that would have been a banner quarter of performance for them. But based on stock selection, they've actually outperformed to a pretty significant degree. So Fidelity International, no surprises here. International indexing is a different proposition than passive indexing in the U.S. markets, right? You can fully replicate the S&P 500. You cannot fully replicate the international, the IFA index, for example, because there's stocks that are thinly traded. There's names that, based on the size of the Fidelity Index Fund, they would own a controlling stake in that publicly traded company. So it's more of a sampling approach. So it'll be in line over the long term, but we did see a little bit of outperformance in the last year. JP Morgan, again, growth bias here. Biggest driver for them was a large position in Taiwan Semiconductor and Mercado Libre. Growth bias for this portfolio continued to benefit them for the quarter, seeing a nice recovery in performance. And then finally, real estate. From a traditional commercial real estate standpoint, we saw negative returns in the fourth quarter, and we saw negative returns again here in the first quarter. The negative returns we saw here in the first quarter were actually across the board. When we say negative, I'm not talking down 30 or 40%. I'm talking property values in general being down 1 or 2%, and then because you have leverage added to the portfolio, that 1 or 2% decline actually becomes a 3 or 4% decline because of the impact of being levered. So no results yet out of TerraCap. We'd actually expect positive numbers. The TerraCap portfolio, remember, that's a closed-end fund, meaning we committed a total of $4.2 million. All of that money's been put to work. That portfolio, as it sits right now, is about 70% multifamily, and then the balance, 15% each to industrial and actually suburban Class A office. But that suburban Class A office is in Phoenix, or it was in Orlando, that's now subsequently been sold. It's not in Midtown Manhattan, it's not in Chicago, it's not in San Francisco. It's in areas where there is a constant influx of population and constant net absorption of available space, such that they can come in, buy this building, put a little bit of aesthetic improvement into it, and fully lease it up without any issues. But again, 70+% of that portfolio is in multifamily in Austin, Savannah, Phoenix, Orlando. They did have an apartment building in Bonita Springs that they sold in the fourth quarter. So again, it's not in areas that are struggling from a population standpoint. It's in areas where you can't find a place to live because there are so many people moving there. Principal, a bit of a different story. Obviously more of a core focus, higher quality here, broad diversification. We have a $1.7 million unfunded commitment to them that has not been called, which we actually view as a positive thing. So initially committed $2.5 million. That's obviously been positive.
Brian, before we get into that,
Sure.
I'd like to pursue that as item B in terms of the full discussion of real estate. But if there's any questions in terms of the overall funds that anyone has. I guess the only comment that I have, Brian, and we can pursue it as we go on, and we've talked about Edgewood in the past, and we've had them had discussion with us, and they've had a very good first quarter. Is just looking at it overall, they're really the only fund since inception that we have a significant deviation from what the benchmark is. And they had an excellent first quarter, an outbeat, and had. So I guess I'm just thinking that, at what point, if any point, should we be kind of looking long-term at these and say, they've had a good run. Currently, long-term, we're not sure. And maybe we should, just, again, not based on current performance, but just long-term and kind of thoughts on that.
So tucked at the back of the book on page 11, so up until this page, everything that you see in the book is your live performance. From when the Fidelity S&P 500 index was added to the portfolio, or when Edgewood was added to the portfolio. But the majority of these funds have a much, much longer track record. So at the back of the book here, this is what's called composite performance. So this is the manager's overall track record. Your performance may differ a little bit just based on cash flow and timing of when an investment was made, but this goes back and now lets us look on a longer term lens. And obviously these numbers are all as of March 31st of 23, but where we have a bit of comfort with Edgewood is, kind of the middle term results, really because of an abysmal year last year in calendar year 22, those near term results. But from a peer group standpoint, if you look out 7 and 10 years, top third of their pack from a peer group standpoint on a 7-year basis, 15th percentile on a 10-year basis. And while they lag the index for both of those time periods, I'm a huge proponent of passive investing. I love the S&P 500. It's a very difficult benchmark to meet. But buying the Russell 1000 growth right now scares the daylights out of me, because there's 4 names, the top 4 names comprise like 40 to 45%. Like, it's a very concentrated benchmark. So from a risk control standpoint, some of the underperformance you've seen from a majority of managers has simply been, look, we're not comfortable owning more than 7% in a name. It used to be 5 was the max we would own. Now that number is 7, and Apple's 12% of the benchmark, because it's so much larger than everything else. Or Microsoft is 10% of the benchmark. That we're uncomfortable from a portfolio construction standpoint saying the least, think about it. My risk from a performance standpoint is, if I say I'm only going to own 7, because that's the maximum amount I'll own from an individual position size, but the benchmark is 12, well, if that stock rallies, I'm going to underperform. All else being equal, because I own less of it than the benchmark. I look at it and say, just strictly from a risk control standpoint, I would rather be active in this space than passive, because of that extreme concentration that doesn't exist on the value side of things. It doesn't exist to the same degree in the S&P 500, because you've got other names that are included. Apple's only 6%, not 2x that. But when I look at this at Edgewood on a long-term basis, in terms of how would I consider other peers, they're top of the class, at or near the top of the class.
Okay. Thank you.
So there's continued value in holding on to it.
Yes.
Do you think it warrants looking at comparable funds, or your?
I think so. I think that's always a great exercise, and this group seems to have a high correlation between taking a deeper dive into a strategy and subsequent.
And the fund going up.
Exactly.
Okay, good. I think I'd like to do that, just to kind of see some various funds.
Sure, we can do that for July meeting.
Great, thank you.
And then what is our current balance, or how much do we owe of that? Am I looking at that correct on page 10?
So that, take it back to page 7. So we have 10.1 million in Edgewood. It is 12.5% of the overall system. And it's kind of set up, if you think about the large cap allocation, it's set up pretty close to a third, and Cora with their active large cap value portfolio, the S&P 500 index fund with Fidelity, and the active large cap growth portfolio with Edgewood.
Any other questions? Okay, let's spend some time on discussion of real estate and get more into principle. Brian?
So the couple differences between TerraCap and principal. TerraCap's closed end. Money goes to work. You can raise your hand and say, hey, give me my money back, and they'll say, we will when we sell a building. The complement to that is a fund like principal, which there's 40 to 45 core, open-ended, broadly diversified funds of varying sizes, from $3 billion to $50 billion. And the idea of the open-ended funds is they offer, majority of the time, quarterly liquidity options. Meaning you can raise your hand and say, I need $100,000 back, or I need $1 million back, or I need $20 million back from a rebalancing standpoint. I say the majority of the time because right now we're in a period where, given the significant increase in rates last year and the significant decrease in transaction activity, apartments aren't selling, office buildings aren't selling, retail strip malls aren't selling, predominantly because the debt costs have increased so much. Principal has actually paused their redemption pool. They're still paying out dividends to investors, but if you've requested a redemption request, they've pressed pause. The term is they've gated. The entire industry has gated. Some did it early, some have done it within the last 6 months, but every core fund that we're aware of has some gate up, whether it's a 100% gate or some might have a 25% gate, meaning if you ask for $1 million, you're getting $250,000 back. Where I give principal a lot of credit is not only have they put a gate up from a redemption standpoint, is they have also said, we have, and I'll put dollars to it. So it's a $3.1 billion fund. They have a redemption queue of $290 million. They have an inbound queue, so people that want to put money into the fund, of $522 million. So there's more money that wants to get in right now than wants to come out. Everybody else that I know in the industry would say, okay, well, I'll just take your money and, right? Take money coming in and wipe out the redemption queue. Their stance on it is, look, if we don't think the market environment is such that we can sell an asset to be able to make a redemption payment, then we're not really in a position where we should be taking in new money, because if we can't sell it, right, like, I view it as being a really good corporate citizen, because from an industry standpoint, like, you want your money back and you want to put your money in, well, okay, I'll just swap those transactions, and I've made the new investor happy and I've made the existing investor happy. They've said, and this redemption queue's, sorry, the redemption queue's been in place for 6 months. The inbound queue has been in place for the same time. So they just put the gate up and said, no money's coming in, no money's coming out. The first expected capital call, so clearing some of that inbound queue, is they're forecasting possibly July 1, maybe later than that. So we have $2.5 million invested currently. We have an unfunded commitment. We made a follow-on commitment of $1.7 million. So that money is out there and is outstanding. We have the ability to rescind that $1.7 million contribution, and we think we should. Not because of any concerns over principle, but simply in this environment, I like the idea, we like the idea of being a little bit more flexible, a little bit more nimble. There's going to be some opportunities that come as a result of everything that's going on in the real estate market. TerraCap's back in the market later this year with their Fund 6. That could be an opportunity. We're looking at some triple net lease funds that are all, it's the Amazons, CVS's of the world, like just something different than traditional core high quality real estate, of just being a little bit more flexible and a little bit more nuanced in what we look at throughout the year. And we have this opportunity to be a little bit more nimble. Let's take advantage of it.
So let's have some discussion. And let me just start by saying it's, real estate is always a fascinating asset class, and it's always a little different and nuanced, different than what people might think going in. When we looked at these funds, we knew going in, and let me just, one of the biggest risks going in, real estate fluctuates long-term, and our goal was long-term, so we weren't looking at it on a quarterly or semi-annual basis looked at. And it was really strongly, the concern going in was knowing that actually TerraCap was fixed, and that that there wasn't going to be liquidity. And there was a lot of discussion as to really cautionary, let's just remember that if we need money, this isn't going to be a fund that's going to provide us funds, and then we're going to need other avenues to do that, and we need to just know that going in with our eyes open. So, and Principal was the fund where there was an ability on a quarterly basis to have redemptions, distributions, and that was really the one that gave us some flexibility if we were coming near our 10% cap, if we wanted to do some different things. Interestingly, the opposite occurred, where TerraCap had some great investment scenarios where two of them, and so we received basically 10% back of our investment there already because of the apartment complex in Bonita Springs, I think, was close to a 50% internal rate of return. There was a high-tech industrial park in Orlando that had close to over a 30% internal rate of return. So great performers, and again, because they're rated on their internal rate of returns and how they work, and it's they distributed the money back. And by the way, I should add that the money that's in the 1.7 is still invested in equities. So it's invested. It's just not in real estate right now. So it's sitting out there, and one of Brian's comments coming into this is one of the reasons he likes TerraCap is they invest the money immediately because they are internal return related. So when they call it, it's going to get invested, and it's not going to sit there. On one hand, Principal's credit is that they're not taking and swapping the money. On the other hand, quite frankly, if we were in a mode where we wanted our money back and we're in the $250 million and we see $500 million sitting out there that wants to come in, I'd be saying, give me my money. Yeah. So now we're the 1.7 within the 500 million queue. And it gives us an opportunity, so it gives us an opportunity really to look and see, clearly there's legacy with Principal in terms of the equity, the properties they hold. One of the real opportunities with TerraCap going into this fund was their properties they weren't existing, they were purchased. So they could really capitalize on what was going on in the current market and not deal with some of the legacy issues. And for whatever reason, and clearly Brian has talked to a number of them, Principal has their gates up, as do others. So again, it gives us an opportunity to look. Brian thinks that in talking with Principal that we have at least up to July 1 before that money may be redeemed. And we have a termination letter or withdraw, to terminate on hand if we want to sign it. I think it may be, I guess I'd like to hear what the committee's thoughts are regarding the discussion and go from there.
Well, are you proposing then if we were to take the money from Principal, go to TerraCap or for different company or different investment opportunities?
We're open to any and all considerations.
Okay.
The idea being is, we've made this commitment of 1.7 million is outstanding. It hasn't been called yet, which has been to our benefit. And I want to be clear, we have no concerns about Principal.
Oh, no.
And like from a property type standpoint, like you think core real estate, you think, well, it's they own a lot of offices. That portfolio right now is 38% residential, which I think is going to be fine. 35% industrial, one of the hottest asset classes right now. 19% office and 8% retail. It used to be office was 40+% and industrial was 10. So they've worked to reposition the portfolio that it's not a ton of legacy. They don't own a whole bunch of suburban Class B office space that literally could give it away to try to get a renter to move in right now. I just like the idea of we've made a commitment. If we rescind it, and if we decide 6 months from now, you know what, things have leveled off, we're comfortable, guess who's happy to take that $1.7 million back? Principal. And if they're putting money to work, guess who's going to put that money to work immediately? Principal. But in the interim, we can take the next 6 months and see what's happening from a real estate market standpoint, look at other options that are out there, at new entrants to the market, at existing opportunities, and just have a more thoughtful conversation around where do we want the balance of this real estate to go. We'd also expect we're probably going to see some more distributions back from TerraCap. So I don't think it's just going to be $1.7 million that needs to go to work. It's probably going to be somewhere in the neighborhood of $2.5 to $3 million that needs to go to work. That's a different conversation. That could be a meaningful, that could be a commitment to a new investment that would be meaningful to the retirement system rather than a top up on an existing.
And I guess to further add to that, TerraCap is looking at coming out with a new fund, so it wouldn't be investing into the current Fund 5. They do have a premium, or they did have a premium in Fund 5, where if you were an early investor, they took less of a carried interest to those investors that came in later. So I'm not suggesting we put all the money in there, but it might be something that we might want to look at just to keep a constant balance with TerraCap, just in different funds. So we'll clearly look at that as that information comes out further.
And their first close is expected late third, early fourth quarter. So it's not July decision. It's there's plenty of runway there in terms of making a decision on that if we wanted to be able to take advantage of first close discounts.
I kind of like the ability to use the unexpected flexibility to say, let's look now and see what possibilities we have. I think it's been a good move to allocate those to the real estate sector, but right now, rather than just go through, it's kind of like a little bit of a gift to say, let's sit back and look at things.
Yeah, so I always believe that more opportunity gives us more chances, right? Like, so right now we've committed to it. If we pull some of that money back and just give it the sideline, it gives us more opportunity, whether it's value add or other opportunities, whether it's TerraCap or somebody else.
Correct.
I would just be cautious of putting, 70 or 80% of our real estate investment money into one fund, just because when we talk about like rebalancing that portfolio, it's 10%. So if we want to commit more money to it, that would be okay with me. It's a matter of making sure we appropriately balance our real estate portion.
Agreed.
Any other thoughts? Okay, so go
I'll
ahead,
make a
Chris.
motion that we rescind the 1.7 million at this time.
Perfect.
So that we have more options when it comes to looking at new suitors.
I'd second that.
Okay, we have a motion and a support. Any further discussion? All in favor?
Aye.
Okay, that passes. And that will be reported on as we go. In terms of, just so I can say formally, this body is a recommending body. If something comes up, I doubt it's going to, but if something comes up that quick, I would have as the treasurer the authority to make that decision. I clearly want this board's input and would do anything to achieve that, but if there's a timing situation, I would probably communicate with the members, but again, it's just the statutory authority of the position. I could do that, but I did want to bring this before this body because I think we've spent a lot of time talking about real estate, and I am going to move forward with that recommendation. Any further discussion about real estate? Okay.
Will you bring the reallocation strategy to the board then?
We're not
Or
changing
not reallocating the overall portfolio or percentage-wise, but just the movement of it?
I could discuss this at the board meeting.
Okay.
But again, we're not changing the investment policy.
Right. No, I didn't
So I'm just saying, so just to be clear and
Right.
formally, the investment policy of the board isn't changing. The allocation to real estate isn't changing. The same format is going to come through where in the past, again, the treasurer really is the kind of the chief investment officer and has the discretion to do it. I bring this forward to the committee because it's an excellent body for good thought, and so I'm bringing that through in terms of input and recommendations, and I will do the same with the board in terms of updating them on real estate. The next meeting that we have is set for July 26, 2023 at 8 a.m., which again follows the Retiree Healthcare Committee. Does anyone have any issues with that date? Okay, then that'll be set as normal. Is there any new business? Okay, hearing none, I'll ask for a motion to adjourn.
So moved.
Second.
And all in favor?
Aye.
Okay, we are adjourned.
All right.